Okay, everybody, we're going to get started. If you are joining us today for the first time, welcome, welcome. If you are a repeat person that is joining us, then thank you for coming back. We do a series of training on lots of different programs, not just for realtors, but also for homeowners who are looking to try to take advantage of all of the different options that are out there for them. So whether you are a realtor on this Zoom, or if you are a homeowner looking to purchase a house and you're interested as to how this particular product can help you, we encourage you to follow us and to keep track of our social media, because today we're doing this on Hometown Heroes, and perhaps there may be another training on a different subject in the future that could really help you. So I am Melinda Payan. I am the owner of the company. I have been a broker owner in the mortgage industry, have owned either this company or another company for about 25 years. So I've been doing this a very long time. I like to tell people that I started when I was 7, but that's not the case. I have a passion to really help people and to give them accurate information so that we avoid the pitfalls of all of the problems later on. So it's very important to me that if somebody comes to us, if you are a homeowner that has tuned into this video, or you're a realtor that's listening, or you're another loan officer that's just listening for training, it's very important to me that we try to avoid every possible issue that could come up during the lending process. And so because of that, we try to be as educated and as forthcoming with whatever we could possibly try to avoid as a pitfall later on. So today we're going to talk about Hometown Heroes. We're going to talk about what is it, what has changed, and how could you best use this for either yourself if you're looking to purchase a house, or if you are a realtor and you're trying to help somebody who's buying a house, or if you're a loan officer who's listening in for training, how you can help your borrower also as well. So there are really a lot of changes that have happened in the last few months in this program, but the most recent change that has happened is now this program is open to anybody in any occupation in Florida. Now, there are a lot of other restrictions we're going to go through, but you don't have to be a nurse, or you don't have to be a police officer, and you don't have to have a certain occupation, but you do have to work in the state of Florida. So let's just jump in. One of the biggest requirements about working in the state of Florida and what those requirements are. And then we'll kind of backtrack and go over the other stuff as far as what does it mean to be a first-time home buyer, and would this work for you or your clients personally? So the Florida housing has really drilled down that somebody needs to be working in a brick and mortar location in Florida. So they can't be a virtual employee working for a company that's located in another state. They have to have a brick and mortar or physical location. So they have to have a physical location in the state of Florida in order to qualify for this program. So it's really super important whether this is somebody who is self-employed, and we'll get into a little bit more on the specifics on that. But if you are looking to use this program, you have to have a physical location in Florida. That's the biggest requirement. That's one of the biggest requirements, I should say. The second biggest requirement is that we have to prove that you, the homeowner, or your clients, whoever it is that is using this program, is working 35 hours a week, meaning that they cannot be a part-time employee. They have to be working 35 hours a week in order to utilize this program. So let's just talk a little bit about what that means for people who are either just started working. Let's say you just started working a job. That's okay, as long as you meet the criteria for whatever lending type that you are going to do with us. It's fine that you just started working as long as it's 35 hours a week. Or if you are self-employed, then they need to verify through a third-party source like a CPA or maybe a payroll company, maybe you pay yourself a payroll through a payroll company, that you are working 35 hours a week at your self-employment. So that might be a CPA letter stating that your schedule is Monday through Friday from 9 to 5, as simple as a CPA signing that. Or it could be if you're paying yourself on a W-2, your payroll receipts. But Florida Housing really wants to prove that you're working 35 hours a week. Now, in reference to being self-employed, in addition to a third party that would need to verify that you are working 35 hours a week, if you are self-employed, it's super important that either your company is registered with SunBiz, with the Division of Corporations in the state of Florida, or you have a 1099 that you can show that you received like a contract or like set up with a contract with a company that's based out of Florida. So there's some additional requirements regarding self-employment, but if you are a W-2 person who is working at least 35 hours a week and you have a pay stub that says you're working 35 hours a week, that satisfies the requirement of you being considered a full-time person. But remember, it has to be a brick and mortar location in Florida. If you are working for a computer company and you're doing programming from home and the company is based in California, you're not going to qualify for this program. You have to work for a company that has a brick and mortar location in Florida. That is very critical. They could have a division in Florida, somewhere in Florida, but if their main location's in another state, and you're one of many people who have joined us over the last few years in Florida, we certainly welcome you and love that you're here. We appreciate you being here, but unfortunately, this program is not going to work if you are working virtually for a company in another state. So let's talk about, besides the employment part of it, what do we look at as far as being a first-time home buyer, and what is the definition of a first-time home buyer? So for many people who are on here, if you're a realtor or loan officer, obviously you know that. For the homeowners who are joining us that are listening in on this conference, a first-time home buyer is somebody who has not owned a house in the last 3 years. Now, there are some exceptions within this program, and we're going to talk a little bit about those exceptions. One exception is if you're a veteran, you do not need to be a first-time home buyer. However, you cannot own more than one house. Okay, so if you're a veteran, you do not need to be a first-time home buyer. The second exception is, which is kind of interesting, there is another exception that says if you have not lived in your house, like let's say somebody owns a house in Tallahassee and they moved to Broward and they've been renting in Broward for the last 3 years, and they haven't lived in the house that they own, which is in another location, and we can prove that they haven't lived in the house that they own. There is some exception to that, but there's a tremendous amount of documentation to prove that they've been renting for the last 3 years. So there is an exception on that basis. Then there is basically two different programs that Hometown Heroes are divided in, is divided in. There's the bond alternative program, and then there's the bond program. Now, most people are going to want to do the bond alternative program because it's much more lenient with how much money that you can make, because both programs have income restrictions. So there are income restrictions in both of these programs. But the bond alternative, or the TBA program, allows you to make a lot more money and to have a lot more flexibility with qualifying higher loan amounts, higher income amounts. So most people are going to want to do the bond alternative program. Now, under the bond program, the more restrictive program, if you are purchasing in certain census tracts where they consider it a lower income area, then you do not need to be a first-time home buyer. So there are some ways around being a first-time home buyer. We encourage you to reach out to us, to your loan officer if you are a client of ours, or certainly to whomever that you are discussing this with, which would hopefully be us, to be able to run those exact figures for you. So let's just kind of back up for 1 second in reference to all this information that we just shared, because it certainly is a lot of information. So what we want to do is just take a step back and talk about what exactly is the Hometown Heroes program and how can it help you. So the Hometown Heroes program is basically a 0 interest % loan. It's extremely important to understand that this is not a grant. There's a lot of misunderstanding about that because people think that this is a grant. This is not a grant. This is money that the state is loaning to you at a 0% interest. So you don't have to make payments on it. There's no interest on it, but it is a lien on the property. It is a second mortgage lien on the property. When you go to closing, what will happen is you will need to sign documents to go ahead and put the lien on the property. So you will sign a closing disclosure, you'll sign a mortgage, you will sign all of those documents as if you were taking out a second mortgage, which you are, okay? And there will be a lien on the property for the amount of the money that the state is giving you. So the amount of money that the state is giving you varies, and I'll go into that in just 1 second, but let's just talk about this lien on the property. What does that mean? Well, that means that if you need to get a home equity line later on, or if you want to refinance later on, or if you decide to sell this house later on, or if you move out of the property and it's no longer your primary residence and you keep the house, but you just decide to rent it out and the state becomes aware of that, you will need to pay this money back. So let's just talk about this again. If you refinance the loan later on when rates go down, which is a very high likely situation that will happen, you have to pay it back. If you sell the house, you have to pay it back. And if you move out of the property and it's no longer your primary residence, you have to pay it back. So the loan has to be paid back. Now, you stay in the house forever, you never leave, you never refinance, you never sell the house, that's not a problem. You don't have to make payments on it. There's no interest on it, and it doesn't affect you as far as your credit goes. But keep in mind, this is a lien on the property, and it does affect your ability to get a home equity line later on. So just that's something that we would have to individually discuss. However, it's important to understand that this is a vehicle to help you qualify for a first mortgage or to put down more money to be able to get into the house that you would like. So you do have to pay back in full when you refinance, when you sell, or if you move out of the property. We do have a question in the chat here about that. There isn't any partial payments. The loan is basically called and due when you refinance or sell the property, or if you were to move out of the property. So this is very important to know. There are other grant programs that we have access to. Most of those work primarily with FHA. One good thing about this program is that it works with conventional loans and has a lot more flexibility. So it works with conventional loans, it works with VA loans, it works with FHA loans, but we do have resources for real grant programs. If you want more information on that, please reach out to myself or one of our loan officers after the meeting. So let's just talk about how much money can you get from the program and exactly what you can use it for. So you can actually get up to 5% of the sales price of the sales price of the property you're buying, up to $35,000 with a minimum of $10,000. So what does that mean? If you're buying a $900,000 house, you're still only getting 5% up to $35,000. So you're not getting the full 45,000, you're getting $35,000. If you're buying $100,000 house, you're actually getting $10,000 because the minimum that they will loan is $10,000. So you're going to get $10,000 or up to 5% of the sales price. And that money will be the second mortgage that's recorded on the property in exchange for using this program. So let's talk a little bit about what the money can be used for, and then we'll jump into a little bit about the two different programs. So this money can be used for down payment. This money can be used for closing cost assistance. And technically, the money is not supposed to be used to pay down debt. However, if you are putting down 5% on a house and your debt to income ratios are tight, in other words, you're squeaking by in order to qualify, and it would be really great if you could qualify for more of a house, but you just don't have the funds to be able to put the down payment and pay off the credit cards. You could actually use your own funds to pay off the credit cards and then use this money towards the down payment. So although these funds are not supposed to be used to pay down debt, it will free up your money for you to be able to use your money to pay down some debt. So that would possibly help you to qualify for more of a house. Same thing with if the house for some reason does not appraise. So for those first-time homebuyers that are listening, an appraisal determines the value of the house. It's something that the bank does to determine whether or not you're paying a fair price for the house. These funds from Florida Housing will not be allowed to use to pay the difference in an appraisal. It doesn't mean that you can't pay the difference in the appraisal, but the money from the Florida Housing will not be allowed to be used. So you're buying a house for $400,000, it appraises for $395,000. The seller does not want to budge, and somebody has to pay the $5,000 difference. Well, you're allowed to pay that $5,000 difference out of your funds. You just can't use the funds from Florida Housing for that, okay? But if you didn't have the Florida Housing funds, you wouldn't maybe have as much access to your funds. So it's really something that gives you the flexibility of having a little bit more breathing room so that you have the money towards the closing costs, or you have the money towards paying down some debt. It really allows us as your mortgage advisors, because that's really what we are, or it is just really advisors to you, to explain to you, listen, now that $25,000 that you were going to put down is coming from Florida Housing. Guess what? Now we can pay off that $10,000 credit card or that $12,000 auto loan. And now you'll qualify for a $500,000 house instead of a $400,000 house. So it really just kind of depends on the strategy. And you really need to work with somebody that understands those strategies to be able to really give you the best possible opportunity to maximize what you're trying to achieve. So on that same note, let's talk a little bit about what does it mean for you to have a debt to income ratio, and what exactly does that mean with Florida Housing? So for those who are listening that are first-time home buyers, a debt to income ratio is basically all your debt, monthly debt, compared to your monthly gross income. And there are certain restrictions that are in place, whether those restrictions are indicated by the loan program that you are using or by Florida Housing. So what happens is that when you purchase a house using this program, Florida Housing says, hey, we don't want you going over a 50% debt to income ratio, or 45, depending upon your credit scores. And there's a few other factors in place. But there are a lot of other programs like FHA or VA that do allow you to go higher, to a higher debt to income ratio. So what happens as a result of that is you may actually qualify for more of a house, which I know sounds crazy. You would actually qualify for more of a house, sometimes not doing this program. So you really have to speak to your mortgage advisor to go over what exactly is the best option for you. But we do see that happening because the program itself is being more restrictive, not that you can't go to a higher price. So those are things we can discuss with you individually, one-on-one. All right, so let's jump into some of the income limitations. I am going to go ahead and do a screen share just so you guys can see what I am looking at. And if you are interested in these handouts, obviously, please put your email in the chat box and we will get all of these out to you. So I'm going to show you my screen. I think everybody can see the screen. This is an example of the bond alternative income limitations. You can see in Broward, the income limitation is 144,000. These are for USDA loans. That really doesn't apply in much of Florida. We don't really see much USDA loans happening, which they're more agricultural. And then here is the FHA loan limit, and here is the conventional Fannie Mae or Freddie Mac limit. So conventional loans have two components, either Fannie Mae or Freddie Mac. It's kind of like hamburgers and Burger King and McDonald's. They're still hamburgers. So these are conventional loans. That's the limit. This is also the limit that VA would go by. And then this is the limit for FHA, for example, in Broward County. So now I'm going to hop into the other document and I'm going to show you the other document, which is the bond program. So this is the bond program, not the bond alternative program. This is the bond program. So I want you guys to look at how much lower the income limitations are. It's significantly lower. It's also based by how many people are in the house. And with this program, the total household income counts. So for example, if you live in a house with your adult children and they are working, even if they're not on the loan or not on the deed of the property, Florida Housing wants their income calculated in the equation. So you may well over exceed these income limitations because it's household income. And then also the loan limits are lower. So the loan limits are more restrictive. So that is why most people are doing the bond alternative program. So that is basically kind of a rough idea of the income limitations. We're going to discuss something here in just one second, but just as a reminder, if you have any questions and want any of these charts or a copy of this recording, please put your email in the chat and we will send it out to you afterwards. Okay, let's talk about the income calculation. And you're probably saying to yourself right now, why would Melinda need to talk to me, the borrower, or maybe the realtor or whoever you are on this video about these different calculations? Well, it's important to understand that there's a set of calculations that we do for your loan type. Let's say it's an FHA loan or a VA loan or Fannie Mae loan. There's a set of income calculations we do for that. And then there's a set of income calculations that Florida Housing is looking at. So it's really important that you're working with somebody who really knows this program and knows what they're doing, because you may be making a certain dollar amount based on the last 2 years of your income or last year, depending upon the loan program that you're in. And we may have a certain income we're using for the application for your Fannie Mae loan or your FHA loan or whatever the case may be. But guess what? Florida Housing only looks at the last 4 to 6 weeks of your income, even if you're self-employed. So there are certain criteria that we really need to walk you through in order to satisfy that portion of this entire process. Because the last thing that we want is a homeowner or prospective homeowner to be in a situation where they spent $600 for an appraisal and another $500 for inspections, and they've got their kids all excited that they're going to be going to school with their friends, or they're going to be living next to grandma, or whatever the case may be, to find out that there's a problem later on. This is why it's so important for us to be extremely thorough in the beginning, and to also bring to you all of the specifics and what we need to go through, so you guys understand, as either a realtor or somebody who's looking to purchase a house, exactly what the process is involved. So they're really only looking at what you have made in the last 4 to 6 weeks. We then compare it to those income limitations. If you are self-employed, there are certain things that we will get from you to discuss all of this, and such as profit and losses and things of that nature. And we will go over that with you. Now, all homeowners are required to take a homeownership counseling course. There isn't any exception to that. It's very important that they take the course. It's a very simple course, short period of time. We are allowed to use a cosigner. You are allowed to have a cosigner depending upon the loan. It could be a non-occupant cosigner. So those are a few different options. One interesting thing is that these loans are exempt from doc stamps and intangible tax. So what does that mean? Well, that's a significant savings on your closing costs. Let's say it's a $500,000 purchase. I'm sorry, let's say it's a $500,000 loan amount, because the doc stamps on the mortgage, which are charged by the county, and the intangible tax, which is charged by the state, are all based on the mortgage amount if you are the buyer, okay? And let's say it's a $500,000 loan. These loans are exempt from being charged any taxes from the county and the state from a perspective of the closing, not from a property tax perspective. You still have to pay your property taxes. That's a whole nother ball of wax. But this could save you like $3,500 in closing costs, because that's approximately how much doc stamps and intangible tax, somewhere maybe about closer to $2,500 on a $500,000 loan amount. But that's a pretty decent savings. Now, the seller still has to pay their doc stamps on the deed, which is a separate thing and has nothing to do with you as the buyer. But this actually could save you some money on your closing costs by utilizing this program, because some people may say, well, do I want to do this program or not? I'm not sure. I already have a down payment. We would have to really compare your individual situation, because the interest rates are actually set by Florida Housing. So going back to comparing your individual situation, we may say to you, hey, this program makes a lot of sense because you're saving all this money on closing cost, and you could be potentially saving money on the monthly mortgage insurance, which I'll explain here in a second. Or we may say to you, hey, this doesn't make sense. You can get a better interest rate because you're already are working with a decent down payment. Okay. And we'll let you know honestly what we think. So let's talk about mortgage insurance, and we're going to open it up for questions here in a second. But what is mortgage insurance and how does it work? For those who are in the industry, I'm sure you already know the answer to this, but for those who are first-time homebuyers that are listening, mortgage insurance is an insurance policy that the lenders take out when you do not put down 20%. It repays them a certain amount of money if you were to go into foreclosure on the house. So it's kind of like an insurance policy on you, because you don't have the entire 20% to put down. Depending on the type of loan that you have, you can get out of mortgage insurance in a few years, or you may be stuck in it for a certain period of time. For example, with an FHA loan, FHA loans do not participate in market appreciation when they look at mortgage insurance, and conventional loans do, meaning that if the property goes up in value and you have 20% equity in a few years from now, if you're in a conventional Fannie Mae, Freddie Mac loan, you can apply to get that mortgage insurance removed without refinancing. FHA loans go off of the amortization of when you originally bought the house, and they do not count market appreciation. So you're really kind of stuck in that mortgage insurance unless you physically take money and pay the loan down. So let's talk about what affects the mortgage insurance in this program. Mortgage insurance premiums in this program are lower if the income is below a certain limit. So you actually may benefit from doing this program. Your monthly mortgage insurance, if you're not putting down 20%, may actually be lower if you have income at a certain limit, or if you're in a certain census tract, depending upon your personal situation. In the event that you are doing this program and your income is on the higher end or over a certain income limitation, we'll have to compare that and see if it makes sense, if the mortgage insurance is better on this program or by you going outside of this program. But in general, if you are making about 80% of what the average median income is in the county, 80% or less, you may get a break on your monthly mortgage insurance, which would allow you to have a lower payment. So again, this is another strategy that we, as your mortgage advisor, will review with you to determine what is the best option for you. So one other thing I just want to mention before we open up any questions. If anybody has any questions, you can certainly put them in the chat, and then I'd be happy to answer any questions. Is that one interesting thing with this type of loan is you can't actually lock in the interest rate until about 2 weeks before closing. So you really are kind of taking a chance of the market here, but Florida Housing will not allow us, will really not allow anybody to solidify your reservation of the money until 2 weeks before closing. So you can't lock in the interest rate until 2 weeks before closing. And there's usually not an extension, or there's a very minimal extension of that interest rate. So let's say you're purchasing a house, you're using this program, you are 2 weeks from closing, you're going to go ahead and have to float your interest rate. So you're really not certain what the interest rate is during the first few weeks of the loan process. We can give you an idea, but it's not locked in. Of course, we can give you an idea as to what the rates are when you start the process, but it's not locked in. It's subject to whatever happens in the bond market, whatever happens economically, until 2 weeks before closing. Okay, now it's 2 weeks before closing. The interest rate is locked in. You're on your way to closing. Everything is wonderful. And then something happens and the closing is delayed. Generally, if it goes past 5 days, you're going to lose the interest rate lock and it has to be relocked. This is not something from Melinda at The Truth About Lending. This is not something from Bank of America, from Chase. This is set by Florida Housing. So it's the same rule that applies to everybody across the board. But these are things that you need to be aware of as a home buyer, especially the agents who are listening now, because it's very critical that the dates that we set are really we really try to achieve those dates. So, okay, guys, I'm going to open up for questions. If anybody has a particular question on the Hometown Heroes, you can either put it in the chat, or if you'd like to unmute yourself, feel free, and I'd be happy to answer any questions. Anybody have any questions? Nope. I must have done a really good job explaining. That's great. Well, if that's the case, then I am going to go ahead and wrap everything up for today. If anybody would like to reach out to me directly, feel free to. My contact information was in the beginning of this registration of the Zoom. We have over 15 loan officers who will be happy to help you and guide you through the process, or guide your clients through the process. And we are very, very thorough with everything that we do. We appreciate your time, and please feel free to reach out to us directly if you have any other questions. Have a great day, everybody. Thank you so much for attending.